Hi everyone, welcome back to Muffet Investment Views. Options can be strategic tools in investing, and if we use them wisely, then they can give us a tremendous advantage compared to strategies using just stocks alone. Today we are going through the basics of options and how to use puts to enter a stock position. First things first, what exactly are options? In the world of finance, an option is a contract that gives the buyer the right, but not the obligation, to buy or sell an underlying asset at a predetermined price within a specific time period. The underlying asset can be stocks, bonds, commodities, or even indices. Options are a type of derivative, meaning their value is derived from the value of an underlying asset. Now, there are two types of options: call options and put options. Let's break them down. A call option gives the buyer the right to purchase an underlying asset at a specific price, known as the strike price, before the option's expiration date. Investors typically buy call options when they expect the price of the underlying asset to rise. If the asset's price goes up, the call option becomes more valuable because the buyer can purchase the asset at the lower strike price and potentially sell it at the higher market price. Options give you leverage. Each option is worth 100 shares. Options can also reduce overall risk. Let's look at an example. An investor thinks that Albemarle shares will go up and is bullish on the stock. Here is the call options chain for Albemarle expiring in 1 month's time. The investor buys the $98 calls for $7.43. Here the strike price is $98, and she has the option to buy Albemarle shares at $98 before expiry on August 23, 2024. The $7.43 is the option's premium that the investor paid to buy the option. There can be 3 scenarios at expirations: Albemarle shares below $98, Albemarle share at $98, Albemarle shares above $98, Albemarle shares below $98. The call option expires worthless, and the investor loses $7.43. Albemarle shares at $98. The call option expires worthless, and the investor loses $7.43. Albemarle shares above $98. The call option has a value which depends on how many dollars the Albemarle shares close above $98 strike price. Let's imagine a scenario where Albemarle shares closed at $110. In this case, the call option is worth $110 to $98 equals $12. As the investor has paid $7.43 for the option, their profit would be $12-7.43 equals $4.57. The option buyer gains 61% in 1 month, even though the price of the Albemarle share has gone up by only $11. This is the power of options leverage. However, if the price of the Albemarle shares closes at $102, then the option buyer will lose out. This is because they paid $7.43 to buy the option, and the value of the option at expiry is only $102-98 equals $4. So they lose $3.43. Options not only give you leverage, but also reduces risk to a certain extent compared to buying stocks alone. Supposing the Albemarle shares closes at $80, then the option buyers will lose the $7.43 premium paid. But the investor who bought 100 shares of Albemarle at $98 would have lost $18. Although options give you leverage and reduce risk, the probability of winning is low. In only one of the 3 scenarios does the option buyer win, so his probability of winning is low at 1/3. On the other hand, A put option gives the buyer the right to sell an underlying asset at the strike price before the option's expiration date. Investors buy put options when they expect the price of the underlying asset to fall. If the asset's price decreases, the put option increases in value because the buyer can sell the asset at the higher strike price even though the market price is lower. Again, each put option is worth 100 shares. And put options can be used to reduce overall risk. The buyer of the put speculates on the movement of the share price. The seller of the put option is like an underwriter. He has an obligation to buy the stock at a specific price. As he assumes the risk, he is paid a premium from the put buyer. Let's look at an example. Here is the put options chain for Albemarle for August 2024. Supposing an investor is of the view that the Albemarle share price will go down in the next month. She looks at the options chain and she buys the $96 put for $6.23. Here the strike price is $96. The premium paid is $6.23 and the expiry date is August 23, 2024. Again, there can be 3 scenarios on August 23, 2024. Albemarle shares below $96. Albemarle share at $96. Albemarle shares above $96. If the Albemarle shares close above $96, then the puts expire worthless. The same would be the case if Albemarle shares are at $96. If the Albemarle shares close below $96, the value of put depends on how far below the Albemarle shares close below $96. Let's suppose the Albemarle shares close at $80. The value of the put option is $16. As the put buyer paid $6.23 to buy the put, their net gain is $16 to $6.23 equals $9.77. This is a 150% gain in 1 month. But if the Albemarle shares were to close at $90, then the value of the option would be $6 and the put buyer would have lost about 23 cents. So not only does the put buyer need to write about the direction, the price needs to move by an amount more than the premium paid for them to be profitable. Now, let's have a quick look at how the options are priced. The options are priced depending on the underlying asset price, strike price, volatility, time to expiration, interest rates, and dividend. The option premium consists of the intrinsic value and the time value. The intrinsic value depends on the underlying share price and the strike price. Let's illustrate with an example. For a put option, intrinsic value equals strike price minus underlying share price. For a call option, intrinsic value equals underlying share price minus strike price. The intrinsic value of the $105 put is $105 minus $0.9787 equals $7.13. The option price, as we can see from the options chain, is $12.23. So the time value of the option is the difference between the option's price and intrinsic value, and this would be $12.23 minus $7.13 equals $5.11. Here is an example of intrinsic value in a call option. This is the Albemarle call options chain for August 2024 expiry. Here we can see the call with the $90 strike price is trading at $11.93. The intrinsic value of this call option would be stock price minus the strike price. So it is $97.87 minus $90 equals $7.97. The time value premium on this call options would be the call price minus the intrinsic value, and so it would be $11.93 minus $7.97 equals $3.96. If an option has intrinsic value, then it is called in the money. If there is no intrinsic value, then it is called out of the money. Let's give an example. The $96 put is trading at $6.23. However, the strike price is $96, which is below the current price of Albemarle shares at $97.87. This means that there is no intrinsic value in the option, and all the value in the option is time value premium. This option is called the out-of-the-money option. TME value premium. The time value premium depends on the time remaining till the expiry, the volatility of the stock, the interest rates, and the dividends associated with the share. The time value premium is an important factor to understand when buying options. The time value premium works against the options buyer in the sense that the premium decays over time, and as the expiry time approaches, there is rapid decay of the premium. The reverse is true for the option seller. The time value premium works for the option seller. The time value premium is ticking against the option buyer. The price of the underlying needs to move in the right direction adequately for the option to be profitable. For example, if you buy the Albemarle August 2024 $95 put for $5.20, then in 1 month's time the price of Albemarle should have fallen below $89.80 for you to make a profit. As discussed earlier, the chance of a favorable outcome is 1/3. Not only do you have to be right about the direction, but you also have to be right on the time to be profitable. The option seller, on the other hand, has an obligation to buy 100 shares at $95. Remember, each option is worth 100 shares. He is assuming some risk for which he is paid the $5.20. If the Albemarle share is assigned to the option seller, they have to buy 100 shares at $95. But as they collected the $5.20 premium, their net entry on the stock position is only $89.80. And they only lose out if the price of the stock is trading below $89.80. The put seller usually sells the option for 2 reasons: to buy stock at a lower price, to collect premium as a form of income generation. At Muffet Investments, we sell put predominantly as a way to buy stock at a lower price. The time value premium decays exponentially as the option approaches its expiry. Not only that, the chances of a favorable outcome for the put buyer is 1/3, and the chances of a favorable outcome for the put seller is 2/3. Warren Buffett advice: it is better to be a seller of options than to be a buyer. Warren Buffett advice 2: you should only sell a put on a stock you are happy to own long-term. In 1993, Warren Buffett wanted to buy more Coca-Cola shares, but he did not want to buy them at $39 that they were trading. He instead sold the $35 puts for $1.50. He sold 50,000 puts, which netted him a cool $7.5 million as the options that he sold expired worthless. You should have funds required to buy 100 shares of the stock on the sold put. That is why it is called a cash-covered put. In a margin account, you only need to hold 20% of the required funds to sell the put. Now we know that the longer the option expiry period, the more the time value premium that is. So at Muffet Investments, we look mostly at long-term options, also called LEAPs. These are options with expiry period more than 1 year. Let's take an example of Albemarle. We have done research on Albemarle and we think that it is at a level which is quite appealing. The lithium supply-demand dynamics are not favorable for lithium producers, but this will be balanced out eventually as the lithium demand increases over the years and high-cost producers are driven out. The lithium prices are near the bottom of the cycle, and Albemarle is one of the largest producers with vertical integration. However, we will never know the bottom of the share price. We take a very conservative approach to selling the option. Here is the put options chain for January 2026 for Albemarle. We like the $70 put. This gives us a premium of $9.15. This means that if we are assigned the Albemarle shares, our entry price would be $70 minus $9.15 equals $60.85. In our opinion, that would be a very good price to enter Albemarle. Albemarle cash secured put idea. Sell the January 2026 Albemarle $70 put. Collect the $9.15 premium. Wait to be assigned. The idea of selling the put is to be assigned the stock. If we look at the stock chart of Albemarle, it has followed the price of lithium. We think that lithium prices should be supported at this level and likely to rise from current levels if demand picks up in the future. Also, from a technical perspective, the price of Albemarle should be supported at the shaded zone outlined in the chart. If the stock never reaches that low, then we use the premium collected towards buying the stock at a later time. If you found this video helpful, make sure to give it a thumbs up and subscribe to Muffet Investment Views for more investing tips and tutorials. If you have any questions or topics you'd like us to cover, leave a comment below. Thanks for watching and happy investing!